In this lecture, we want to study the S&P sectors and what we call sector rotation. Now, the S&P has 10 sectors. You have the financials, technology, healthcare, and so on. And you have 10 of those. Sector rotation means all the big money, the smart money, they go into a sector when they feel that it's a hot sector, and they'll come out of a sector if it's a cold sector. So now they don't do this on a daily basis. Generally, these kinds of trends last for a little while. So when I say little while, it could be 2 months, it could be 3 months or 6 months or even more than that. So there is a great way to take advantage of this sector rotation, and that's the specific bonus strategy that you're going to get here. Obviously, if you wanted to make an investment, you could buy the ETF itself, or for better returns, you can buy the options, whether it's a call option or a put option. Of course, we haven't come to the section on options, but once you get there, you can see how options work. And you can also make an arbitrage trade. So there's like 2 or 3 trades here that I'm going to show how you can take advantage of sector rotation, because you want to invest in hot sectors, you don't want to be in cold sectors, and these trends last for a while. So let's go over and I'll show you a few things. This is a free site. It's called stockcharts.com. They do have some premium products as well, but this is generally free. And there's a couple of very interesting analysis tools here that we can see, especially for the S&P sector. So here, if you see here, if you come to stockcharts.com, on their main homepage itself, you will see the S&P sector performance chart. So if you click on that, what you're going to see now is which sectors are hot, which sectors are cold. We are looking at almost a 1 year, maybe 9 months. It starts from 7th May 2015 to 22nd February 2016. So it's about a 9-month chart. Yeah, basically 200 days. Out of the 10 sectors, the best performing sectors has been the utilities. And the worst is the energy. So if you can imagine, the energy sector has been decimated in the last 6 to 9 months. And so obviously that's the worst performing sector. You have utilities as the best performing sector. And of course, these are all the sectors: the cyclicals, technology, industrials, materials. Okay, so it also gives you the ETF right here. So the cyclicals is XLY, technology is XLK, industrials is XLI, materials is XLB, energy is XLE, consumer staples XLP, healthcare XLV, utilities XLU, and XLF for the financials. What we want to do now is to identify which sector is getting hot, which sector is getting cold. And for that, I want to go and do an analysis of a particular sector. Let's take the financials. This chart compares the SPX, which is the S&P 500 index, with all the 10 ETFs. A comparison of the SPX with the XLF. Now, this will show you how the S&P, which is the red, and the financials, which is the blue, performing on a relative basis. So you can see that the financials came down. It went down under the S&P 500, and it is still below. So the financials are underperforming. And that's not surprising, because if you come and look at the chart of an XLF, you will see that the financials in general have been underperforming. Let's see, there was here, this is a classic example of some kind of a flash crash trade on XLF sometime in August of last year. It's a very classic pattern for a flash crash, but it's not a market-wide flash crash. This just happened in the financials. And so you can see financials have been coming down. They've been as high as 25 in the last 1 year. Now it's at 21. And even from our performance chart, you can see the financials have started underperforming the S&P. Now, what you want to do is to catch some of these trends, because some of these trends last for a few months. And so here you can see clearly the financials are above the S&P. And so this would have been a bullish trend that lasted from August of 2015 all the way till almost, December of 2015. In fact, even till January. To confirm that, we go and we see the charts. We're talking about from August of last year, so which is somewhere here, all the way up until December. So it went from 22 all the way to about 25. And some of these trends, they do last for like 3-4 months, sometimes even more than that, 6 months. Let's look at EPI, not last year, in 2014. So I'm going to have to go back a a little bit further. In India, EPI is the India ETF, and when the elections were coming and a pro-business prime minister was being elected, the ETF went all the way from 16 to 24. That's a 50% return in just about 5 to 6 to 7 months. And so you can see that, and probably it's even coming down from a lower level there. And at some point, it petered out and all the optimism went away, and now it's back down to its lows. But you can see that these kind of trends, they last. And although you'll see up and down, in general, the trend was up from here all the way till its high at 24. So these trends tend to last quite a bit, even in sectors. Let's look at the energy sector. You can see that, once a trend starts getting in, it really goes down. So here we are looking at XLE coming down all the way from 101 to 58, and it even went down to 49. Over 50% drop on this particular ETF. And so this is a very huge trend over the last 6 to 9 months. In fact, even further than that. So over the last one year and 3 months or so, that the XLE has been coming down. So let's go take a look at XLE and see how we could have identified when something like this is going to happen, because that's really the key to this strategy. Now, here we are. If we wanted to go back, now you can see clearly the XLE is underperforming the S&P 500. So now this is a good indication, and as it goes even further, you can see the divergence is just increasing, and therefore that tells you it's really weak. But let's go back further. So sometime in April or May, June, July, up until September, the energy ETF was outperforming the S&P. But over here, September or October of 2014, you can see it crosses down. Now, these crosses don't happen that often. You can see the previous cross was when it moved up above the S&P. That was in March of 2014, and it remained bullish for about 6 months until October of 2014. Once it crosses down, this is your cue that this sector is weak. So either you can buy a put option or you can sell the XLE itself. We'll get into the actual trade type in a little bit, but here you can clearly see, you can get this. Once it crosses, that trend doesn't change for a long time. And so if you were in this trade, you could still be in this trade because it never shows any sign of catching up with the S&P, and in fact it's down 26%. It was down as much as 34%. So this would have been a great trade if you were able to catch it July of last year around the $100 level, and you would have ridden this wave all the way down. So you would want to look at which sectors are hot or cold. Obviously, if we go and take a look at the energy sector, at this point, it's really hot. At April 2014, it goes up and it's hot. And so April 2014, somewhere around the middle, and you don't have to time it perfectly. You want to wait for a clear signal. You want to see this nice divergence happening. That's when you know that that is a hot sector now. It's going to outperform the S&P, and therefore it would be a good time to get in. Doesn't have to be a perfect entry. You can wait for the nice signal here and then go, and then up until from April 2014 all the way until October, September, you could have gotten out somewhere here. Once you see it starts coming down on a regular basis, then it's catching up to the S&P, and that would be the time to get out of the trade. And here around September or October, in fact, let's say somewhere here when it was still above the zero line, 0% return, however, this would have been a good time to enter this, and you would probably still be in this trade because it's all the way down from there, and you can see that on this chart right there. So this would be a great way to play some of these sectoral trends, because it's a fact, it's a business fact that right through the year, there are going to be some sectors that are hot, some sectors that are cold. That's just the nature of the business cycle itself. And therefore, when there is a bullish sentiment, you're going to see that technology and financials do well. When there is a bearish sentiment, you'll see that utilities, some of the more safer sectors, will do well. So for example, if we went to stockcharts.com and we just looked at the sector performance, why is utilities the best performing sector in the last 6 to 9 months. And that's because markets have been weak. There's been some concerns. And so people want safety, and safety utilities are your best example of safety. Consumer staples, so which is also a good example of safety. You would invest into these sectors when there is some kind of a concern or crisis. So actually, this might be a good time to start looking at the financials, especially if the markets are going to turn around and become bullish again.